There's some misinformation as it pertains to the cost of homeownership. I want to discuss what this misinformation is and set the record straight. We have the Department of Justice sinking their teeth into this Realtor Commission lawsuit, and this could get downright ugly. I'm hearing certain things from my friends in DC as it pertains to potential regulatory changes that could impact mortgage loan originators. Are you ready to go? Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC
John Coleman.
Yo, what's poppin'?
My new shower. Y'all, who here? I wish this was like in front of a live studio audience like we just did with our friends over at the University of Central Florida.
Shout out UCF.
Shout out to UCF, Dr. Jarley, all the students. That's one of our favorite episodes we get to do twice a year. Today's episode is one of our favorite episodes we get to do because it's current. It's talking current events, and it's also discussing or covering the topics that our audience has reached out to us over the past 4 to 6 weeks with their special request. So we're going to fulfill those, and I know I teased it in the opening, but no, we finally got our glass for our new shower. And you know what I just learned about having a nice new shower?
You got to clean that.
You have to clean it. Yes, I didn't sign up for that. Yeah, I don't know when my wife and I were having that decision-making process of, hey, should we upgrade our 20-year-old master shower? And I was like, well, I don't know. Let's not spend a whole lot of money because we may only live in the house for another 4 or 5 years, max, maybe 3 if we're lucky. But it is a 20-year-old shower. It would be nice to have something more modern. Nowhere in that decision-making process of picking the contractor, picking the tile, figuring out the budget, was it told to me, hey, not only are you going to need to squeegee the glass, which I was fine with. Yeah. Now I need to wipe down the tile.
That's a loss on your end because you chose the tile, but proceed.
And then all of a sudden, I did choose the floor because it's a really awesome rock floor.
The only time you should take rock floor showers is when you're staying at said resort on vacation because you don't have to clean it.
Yes. So now, guess what I'm noticing? I'm going to have to then take my towel. So first I dry off my body. And then after I dry off my body, I have to squeegee the glass. Then when I'm done squeegeeing the glass, I have to take the towel and wipe down the walls. Then I have to take said towel and drop it in the floor and then soak up any of the remnants of water that's sitting there, all so that we can keep our new shower nice.
My question for you is, before this glass door, because you acting like it's brand new, would you have like a shitty curtain?
We just had an old shower that it didn't really matter what we did
because
it was
the door?
Old.
How did you get into it? Was it a curtain you peeled back?
No, it was glass.
It was frosted glass?
It was frosted.
So now this one is clear.
This one's clear. It's super nice, John. It looks amazing.
So that's an L on your part. Get the frosted glass so you can't see the water streaks.
Yeah. Well, I learned something new. So
rip it up.
Well, we're not doing that. Rip it up. We're not doing that because that project is like every other project in life.
Longer.
If you think it's 3 weeks, go ahead and multiply that by 4. It took 12 weeks. Now, some of it was like our fault because we took forever to pick the glass company.
Did you get like one of those showers that has like the sauna, the steam thing?
No, I'm only going to own this house for 3, maximum of 5 years. I got a nice.
Did you get a massage
upgrade?
Head?
No.
Did you get a sit-in bench?
No.
Is it granite? So what that? Do you see where I'm going with this? It sounds like you went to Home Depot and got the prefab and just had them come in on the weekend.
It is not prefab. This was not like just slide it in and it's made of plastic.
It sounds like it.
No, it's a great tile job.
Do you have recessed things to put your toilet?
Yes, we do have recessed things.
Jesus. Okay.
And really nice glass. That's going to take me a lot of work. So you know what my solution is? I pulled this out of the book called JC's Book of Wisdom.
Okay.
I'm just going to shower at the gym. I'm literally just going to shower at the gym because I don't have to wipe shit down when I shower at the gym.
Hold on. Final question. Is it a waterfall shower, or is it coming out the wall type thing? Is it coming from the ceiling?
Wall, John.
What the fuck? Yo, bro,
John,
you did not upgrade.
It looks way nicer. You should have seen it before.
I should not have. Because my shower is a piece of shit. So
yeah, exactly.
I don't have any reason to talk. So
yeah. So anyhow, no, that's what's going on in the life of Do. Besides that, I had an opportunity to do my first official race with Special Olympics of Florida.
There you go.
And I went as a guide. It was a triathlon, And I had this amazing racer. Shout out to Robert. Robert has his own YouTube channel. He's an amazing kid. I say kid, he's 19, 20. So, he's half the age I am. So, yeah, he's a young adult, but I call him a kid.
Yeah.
Because I call my kid a kid, and my kid's 19, and he's a kid. Mm-hmm. But, he completed his first triathlon. He crushed in the water. He just absolutely made me so proud on the bike ride. And he and I have some work to do on the run, but he knows that. And what's most important is he finished. That was his moment. And that was one of the coolest days of the month, was getting to participate in that particular triathlon. So I got to do that this weekend.
Good for you.
Yeah. So nonetheless, let's jump into today.
Go ahead.
Let's jump face first into today. And I don't know if there's any particular spot that you want to start with. I mean,
all the topics sound amazing, Dustin.
Which one excites you the most? The lawsuit? You want to jump into the lawsuit? How about the Department of Justice? That's probably some of your favorite people.
Because I could give a shit the least about that. So, yeah, let's start with the DOJ for $300, Alex.
The DOJ for $300. Shout out to Liz, who wanted us to cover this, honestly, before I was ready to cover it.
Okay.
So, really, she got the scoop before I had the scoop. And then she kind of opened up my reticular activator. Mm-hmm. And then once my reticular activator was turned on, then I could source information that would allow us to come and share it on a podcast like this or content like this.
Okay.
But here's what people need to know. In general, I am discussing the NAR Commission settlement all over again, except this has nothing to do with the class action lawsuit, nothing to do with the settlement, nothing to do with NAR. It has everything to do with the Department of Justice. Mm-hmm. They want a pound of flesh too. So not only did the attorneys and the plaintiffs mm-hmm. who sued the National Association of Realtors and half a dozen major brokerages, and then that one lawsuit created copycat lawsuits, at which point that's why we have the settlement that's supposed to go live on July 1. That's the reason why you and I have done podcast episodes where we covered what it was, and we covered kind of how to respond to it. Now, all of a sudden, the Department of Justice, who, by the way, they had their beef with NAR long before these commission lawsuits. In fact, the Department of Justice has had their beef with NAR going back to like the 1990s. But there was a case opened by the Department of Justice against NAR. And then I don't really know the ramifications from a legal standpoint, but just know this. Whatever the case was opened, it was then closed. It was closed, and both parties agreed that they weren't really going to do anything with it. Now, they didn't agree that they were going to squash it. Mm-hmm. They just agreed they weren't going to do anything with it. Well, now all of a sudden, the NAR Commission lawsuit settlement was announced. NAR petitions a 3-judge panel saying, hey, I know we've had this sitting on ice for the past couple years or past few years, and I know we agreed that we weren't going to do a whole lot with it, but we want to do something with this. And the 3-judge panel voted in favor of the Department of Justice and said, yes, you can reopen your case. Well, here's what this means. The Department of Justice has longer teeth, sharper teeth, and a much bigger bite than any class action lawsuit. The Department of Justice could come into the real estate community and literally take some of the strategies you and I discussed, some of the information that Cindy Velez and I talked about when we did the episode with Cindy, and say, yeah, real estate community, mortgage community, I know that's what you thought you were going to do as a way to operate post this settlement. Mm-hmm. We have a whole nother game plan for you. We have new rules. We have new procedures. We want to actually come in as the Department of Justice, and we want to create new rules for you. And then we want to enforce those rules, and we want to make sure that you follow them. So what I'm getting at, y'all, this is kind of the, hey, you heard it here first, potentially. Because think about it. You and I started talking about the NAR Commission lawsuit over a year ago. Yeah. And then it took a year before it actually materialized. Well, the Department of Justice is now poking their head into this. They're stirring up some more controversy, and they may want to rule. They may want to regulate. They may want to legislate, at which point it could further disrupt the world that we think we're going to be entering into July 1. So right now, here's my advice. Understand this is a thing. Follow it. Trust that you can't do anything about it. You don't work for the Department of Justice. You don't work for NAR. Like, there's not a whole lot that you can do besides be aware of it and then be ready to pivot when needed. Be willing to be the source of information depending on where you are in your career, and be willing to be receptive to change and look for your opportunity, because that's all that most of us can do when regulators force us to change. Is we can pivot with it, we can not resist it, and then we can look for the opportunity. And then once we have pinpointed where we think opportunity lies, then we run as fast as we can towards it. But just know that's out there. And when you and I were recording those episodes, you and I together and with Cindy, this wasn't a thing.
Yeah.
That's how fluid things are right now.
Who snitched to the DOJ? In my opinion, don't they have something else better to do than to hunt down realtors for commissions? Like, shouldn't they be like
at the end of the day,
throwing real bad people in jail or something?
Possibly. Yeah, possibly. But at the end of the day, and I think they do that, but at the end of the day, they are trying to protect consumers. Right. And you could say that there are real bad people out there. I'm not saying realtors are that, by the way, not at all. Or that the real estate community is that at all. But, it's interesting that we'll go down this rabbit hole. I wish our country treated financial criminals the way they do serial killers, child molesters, and rapists to a certain degree. Like, when I look at the guys like Bernie Madoff, or people that literally financially ruin other human beings because of their unscrupulous, greedy behavior. Mm-hmm. Yeah, I wish they were treated in the same light as those that physically cause harm and punishment to others. Mm-hmm. So, the Department of Justice does need to take things that are protecting its citizens seriously. But you and I could definitely make the argument that the DOJ definitely has better things to do. Mm-hmm. But they've had a thing against NAR. And they've had a thing against realtor commissions for going on 30 years.
Damn.
Like if you research this is not their first time looking into it. And they definitely want to make sure that they're not allowing anti-coercion to happen, that they're not allowing for monopolistic practices to happen. Again, I'm not one that thinks that things are monopolistic and that there's a whole lot of validity behind like antitrust, but that's what the Department of Justice is trying to do. And then you have to think broader. Like, this is real estate agents, and this is helping people with their largest purchase of their life. And this is also promoting homeownership or the American dream. But if you think broader, someone could say, well, what they allow or don't allow for the real estate community, what type of precedent does that set for future industries? At which point it needs to be even and fair across the board.
I'm going to make an example out of you, NAR, so the rest of your brothers and sisters act right, basically.
Yeah, possibly. Mm-hmm. Yeah, or like other industries will study how the Department of Justice does or does not have success regulating and litigating NAR and the real estate companies that are part of NAR. And from there, they will set their procedures and policies based on that. So, if you look at the DOJ, it's beyond just home buyers and home sellers, and it's beyond NAR. It's about law. It's about law enforcement. It's also about creating legislation that is congruent across multiple industries. So that's out there. I think people should know about it. They should be aware of it. There's not a whole lot we can do. So my advice to sales professionals is head down, blinders on, and grind, baby, grind, because there's two things that you can control. That's your attitude and your effort. So make sure you're focused on your attitude and your effort. Everything else, it is what it is. It's going to be what it's going to be. Don't resist it. Look for ways to pivot with it, and then look for opportunities. And once you see that opportunity, to me, that's daylight, and we are taught to run towards daylight.
Well said, Dustin.
All right. So switching topics, this is also in the news right now. So United Wholesale Mortgage, aka UWM. If you are a mortgage broker, there's a great chance that you broker to UWM. And if you don't broker to UWM, you probably broker to Rocket. And then everyone else comes second, third, or fourth tier compared to UWM and compared to Rocket. Well, UWM was just recently hit with a class action lawsuit where the plaintiffs, they're claiming unfair business practices. They're claiming RESPA violations. They're claiming RICO, which I thought RICO was reserved for like the Hells Angels and the Mafia.
Holy shit.
Yeah, but they're claiming RICO. And
Drug trafficking too?
No, they are
Okay.
not.
Oh,
No,
damn.
no, this has everything to do with their marketing practices, their business
Okay.
practices, how United Wholesale positions itself to capture market share.
Mm-hmm.
And it's one of those things that, like, I don't have a dog in this hunt. I don't have I am pro the plaintiffs. I'm pro the defendants. I literally am Switzerland on this. Like, I sit in the middle. I'm sitting back. I have my popcorn. I have my fountain cherry Coke, which I don't drink soda, but if I'm ever going to drink soda, it's a cherry Coke from the movie theater with my popcorn, layered butter, by the way.
All natural.
Yeah, not all natural. But, I'm sitting back and I'm watching it. And, all I can tell people, there's a really great write-up. And John, will you put some of these links in the description on our YouTube channel?
Yeah.
So I'm going to talk about some articles, and John will make sure that if you subscribe to the TLOP YouTube channel, which, by the way, you can watch all of our episodes on YouTube, so you don't have to just listen to them on Spotify, Apple, or anywhere you go to listen to podcasts. You can actually watch them on our YouTube channel, and I love our YouTube channel because our YouTube channel has other content, right? It has shorts. It has highlights from some of our best shows. It also has intentional content. That's where you and I create what I call a quick hit, 5 to 6 minute YouTube videos, but it has playlists. So, like, we have a home buyers playlist. We have an MLO playlist. We have a shit they don't teach you in school playlist. And we even have a real estate investor playlist. That's our way to curate our content so people don't have to, like, scroll through 400 plus videos to try to find something that matches what they're wanting to learn about. No, just go to the playlist. And then from there, we've at least narrowed your search for you. So John will, on the description of today's episode, he'll put some of these links. So there's this attorney he's a who's who in the mortgage industry. His name is Brian Levy, Levy. And Brian, if you followed him for any time period, he makes no secret that he hasn't been like the biggest UWM supporter. In fact, he would say that he has been pretty vocal to point out various business practices that he doesn't necessarily agree with. That said, he wrote a phenomenal article in his Mortgage Musings where he starts off by letting you know where he stands, but then he breaks down all of the various charges that United Wholesale is being accused of. And he speaks as central and neutral as he can as an attorney, talking about why one potential charge could be total BS, why one potential charge could have merit. So the little bit of research I've done is, here's my take. I think this is a hit piece, but I also believe that where there's smoke, there's fire. So this is going to be an interesting news piece, a current event that we're going to want to follow. Just like we were talking about the NAR Commission settlement a year ago, that thing didn't go away. I don't know if this particular lawsuit, just like the NAR lawsuit, it didn't go away. I don't see this one's going away. I think it's something that we will want to follow. And I think regardless if you're a mortgage broker, regardless if you broker to UWM, regardless if you're an IMB, regardless if you're the consumer, regardless if you're a realtor, work at a credit union, a bank, etc., this will impact our industry. This will impact how borrowers borrow, how home buyers obtain home mortgages. This will impact potentially, and I think with a strong possibility, the future of loan origination, regardless if you're a broker or a banker, regardless if you even broker loans to United Wholesale. So we want to watch it because, again, not getting into too many specifics or details because we're trying to keep this show to, that length where you can drive from the house to the office, listen to it, and not have to listen anymore when you drive home. But I do believe it was a little bit of a hit piece, that there's an ulterior motive. I don't think it was a hit piece by Rocket Mortgage, by the way. That's what United Wholesale is claiming. Oh, this is a hit piece put on by Rocket. No, but it could have been a hit piece put on by a investor, like a hedge fund, who has substantial holdings in Rocket stock, or maybe they had substantial holdings in United Wholesale and they had shorted that stock, so they wanted to put out this news article that would potentially help them make money based on how they traded United Wholesale stock or Rocket stock. But then again, they wouldn't put something out there if it didn't have merit
All right.
because you would then subject yourself to a lawsuit for libel or slander. So that's where I'm like, hey, look, I'm not going to deny that there was an ulterior motive behind this lawsuit or behind this article that discusses the lawsuit. But I'm also going to say where there's smoke, there's fire. And I'm going to go out on a limb and say this lawsuit will change a lot of things about how home buyers borrow in the future, how brokers broker in the future, and how even IMBs operate. So it's worth watching, and I wanted to let you all know about it now. You can look it up. You can do a quick Google search. Our friends over at Housing Wire have covered it. I believe we have an article about it up on tloponline.com. So you don't have to be a member of our coaching community to go to our website. And if you go to our website, that's a great place that you can sign up for our newsletter. By the way, it's free. So make sure you're signing up for our newsletter because I talk about stuff like this in the newsletter. I write it myself, and then the team sends it out every Thursday. So go to the website, sign up for the newsletter. You can also go to the website and see in the news. And I've already posted articles that cover this lawsuit. And then in today's description, you'll have Brian Levy's link to his mortgage musings that I really appreciated reading.
Well said, Dustin.
So we should be tuning into that. Now, along those same lines of changing the landscape, I had an opportunity to go speak at the Florida Mortgage Bankers Association, did their biannual, right? Twice a year. Twice a year, they host a loan officer mastermind summit. And I was very fortunate that I was one of the keynote speakers at this event. They did a top producer panel. Shout out to those top producers, Robbie Sampson, Jane Floyd. There's another lady that I can't remember her name. It was moderated by powerhouse in the mortgage industry, Yvette Claremont. But then I spoke, and then our buddy Amir spoke.
Shout out Amir.
And then at that event, there were some who's who from DC in the who are a part of the Mortgage Bankers Association, the national level. And I was having a conversation one-on-one, off the record. But, you know, I'm going to tell y'all that my friends in DC are telling me that the CFPB, they are fully aware of how the mortgage industry has gone about compensating their originators, whether they're mortgage brokers, whether they are bankers at IMB, etc. And they are going to be what I call auditing and advising. And it's only a matter of time that we as an industry, I'm not speaking specific companies, but we as an industry, it is being hypothesized, it's being predicted that in the next, I don't know if it's 3 months or 9 months, we will be hearing the advice from our key regulator, the CFPB, right? Consumer Protection Financial Bureau. Did I say that right?
Don't look at me. I don't know.
Consumer Financial Protection Bureau, CF. It's CF.
College football playoff bureau.
No. I'm like, I'm pretty sure I just said that inversed.
Yeah.
Yes, a little slip there, but yes, CFPB. Anyhow, holy cow! Let me get a drink of water and hope it's not water in this mug. But nonetheless, what I'm hearing, and by the way, we covered this on an episode probably 3-5 months ago. Our friends at Housing Wire did a 2-part series where they covered this. It has caught the attention of the CFPB, and the CFPB is going to be auditing how lenders have been compensating their originators, how brokers have been compensated, how wholesale lenders have been compensating the companies that the brokers work for. And they're going to be, quote unquote, given advice on what we're doing well, what we're not doing well, and where we need to make changes. And by the way, when the CFPB gives advice, they don't do so like nicely and politely typically. They typically rule with enforcement. They come out with fines, with penalties. They want you to pay for making a mistake, for doing things, for coloring outside of the lines. So I think we should continue to monitor that and be aware of it, because I anticipate, based on conversations I'm having by traveling the country and talking to in the know individuals, this is something that has not made the news, but I'm letting you know, be on the lookout. It's going to make the news.
Well said, Dustin. I don't have no idea what the hell you're talking about.
All right, well, you're gonna have a little bit of idea of this next conversation that I'm gonna have to get my phone out for this one.
Yay.
Okay, and this one really impacts home buyers and real estate agents, probably more so than it does the lending community.
Okay.
But if you're a part of the lending community, you definitely want to have this type of content at your fingertips because your community is relying on you to be the source of information. You need to be your local community expert. You need to be creating content like we create content, but you don't have to do it on the national level. Just do it on the local level. Your audience doesn't have to be 30,000 or 100,000 the way that our audience is. Their audience could be 3,000, right? It's about going deeper, not going wider for most people who are solopreneurs, who are trying to generate leads, close transactions, and make a really good living. So I share this content so that you can repurpose it and create your own content and use it to market your knowledge of the industry. But at a Zillow recently, really cool article where it talks about like the better markets for people to be buying regardless of interest rates. Because right now rates are staying higher for longer. Again, we did a whole entire episode on this and what does it mean? And I think they're staying higher for longer. Like, we thought, okay, rates aren't going to start coming down in May. It'll be June or July. Now it's like rates aren't going to come down in May or June or July. Holy shit. Maybe September, maybe October. Only time will tell.
Yeah.
Okay. That's going to put a massive drag on people's ability to buy homes. Not because there's not a demand, because the sellers of the homes are locked in. And we as a country, we say this over and over again, we're not building enough homes, period, end of story. Then we're not building enough affordable homes, period, end of story. If there's going to be any government intervention, the government could intervene to help us create the inventory that we need, whether that's with tax credits, whether that's with some kind of financial incentives to the local municipalities, to the local states, the counties, whatever is holding up the ability to build affordable. Mm-hmm. But even that, when you talk to people who really understand how long it takes to actually start building these communities, like you're talking a decade to build the units that was proposed recently by the current administration. So, yeah, it's just something that we're stuck with. So what I wanted to share, and you'll put the link in the description, is here are, I think it's 10 markets that are least impacted. Let's do the top 5.
Okay.
Top 5 markets least impacted by mortgage rates staying where they are.
I know where number 1 is.
Where?
California.
No, least impacted. Meaning people are still going to buy houses.
Yeah.
People are still going to sell houses to go buy another house.
Yeah.
In these markets, regardless if rates are 5.5 or 7.5.
Orange County, California.
Yep. So you would be dead wrong, right? You would get a big fat F on that exam. No, let's start with Pittsburgh, PA. Yeah. If you are in Pittsburgh, Pennsylvania, that market is a market that has been deemed by Zillow as one of the markets where it's most likely people will continue to sell homes and buy homes regardless if rates are 7.5 or 5.5.
Justin Fields needs somewhere to live.
Justin Fields needs somewhere to live, as well as the other 3,000 quarterbacks that the Steelers picked up in free agency. It's only a matter of time before my guy Blake Bortles probably comes out of retirement.
Shout out Blake.
Yeah, shout out to Blake. So, okay, market number 2. We'll stay on football teams for you, John.
Okay.
All right, Buffalo, New York.
Shit.
Yeah, Buffalo, New York. So, again, if you live in or around Buffalo, good news for you.
You're getting a new stadium soon.
Okay, second good news for you is that the lock-in effect, that's what we call it, by the way. The lock-in effect is people not selling their homes because they're locked in at 2.99 to 3.99%. Therefore, they're like, why am I going to sell my house and then go take a rate that's twice as high? No, they won't. They'll take a rate that's 1 or 2 percentage points higher, but not one that's double. So we call that the lock-in effect. But these are markets where the lock-in effect has less of an impact, meaning people are still willing to sell their homes, which means great news for home buyers because as people want to sell their homes, that's more inventory. All right. The third market, Cleveland, Ohio.
Not a state or a city.
It's definitely a city, but I'd argue against it. I'd argue with you that Ohio might not be a state. Yeah. Next in the line, Oklahoma City. Shout out to all of our friends in OKC. So Oklahoma City is on the good list, right? The non-naughty list. And then Detroit, Michigan. Yeah. Motown, Mortgage Town.
Wow.
Detroit, Michigan. Funny, we talked about United Wholesale Mortgage and Rocket. They're both out of they're both not in Detroit, but they're both in or around Detroit. They're both coming out of Michigan, which makes it very interesting because you have one owner owns the Cavaliers, one owner owns the Suns. So some of the best, believe it or not, some of the best information that I have received regarding the feud between Rocket and United Wholesale, and the best information I've received regarding this lawsuit against United Wholesale, and United Wholesale's claiming Rocket's behind it, and Rocket's claiming no, we're not behind it. But where I've gotten the best information was through the sports news outlets.
No way.
Yeah, like ESPN did a phenomenal write-up on it, and it was a business approach, but ESPN wrote about it because it's two owners of two very large sports franchises.
So little
both
kids
NBA teams
playing with their toys and getting mad at each other.
Basically. Yep, and they don't like each other. All right, so let's look at the markets, the lock-in effect is in full effect.
Okay.
The lock-in effect is in full effect in these 5 markets. San Diego, California.
Yeah.
San Jose, California.
Told you I was right. Yeah.
Los Angeles, California.
There it is. I told you.
Yeah, so John, you are right if you just remembered the less favorable versus more favorable.
Sorry. Got you, coach. My bad.
Yes. Yeah. I asked you to draw up a phenomenal running play, and you went with a pass.
I punted the ball. Isn't that what you wanted?
Yeah, and you punted. Yeah. Number 4, San Francisco, and the 5th one is Seattle, Washington.
Jesus, the West Coast just needs to go somewhere with these prices.
Well, I mean, what they need to do is we need to wait for mortgage rates to come down, and then those sellers will start putting the homes back on the market.
Do you know what I think as someone who has no skin in the game when it comes to mortgages or mortgage rates?
Yeah, because you don't have a mortgage.
I don't think they're ever coming down, and I think people should just stop bitching and live with it.
That wouldn't work for us. I mean, if they never came down, at some point, something would have to give. Right? At some point, if they didn't come down, businesses would eventually stop borrowing, which meant businesses wouldn't be growing, which meant businesses would have to do layoffs. As we have more layoffs, then we have less consumer spending. Less consumer spending means the businesses that sell goods to consumers, they start making less money. Therefore, they have to do layoffs. At which point, now people can't afford to live anywhere because they don't have a job, whether it's rent or whether it's owning a house. So then they start commingling residences, meaning moving in with each other, sisters with brothers and children with parents and older parents with their adult children, because that's what you have to do. And then eventually that would flood the market with supply. And then after 2 or 3 years of it, we would see actually home prices come down, because our issue with prices is a supply versus demand thing. We talk about it incessantly on this show, on our YouTube channel. I write about it in the newsletter.
What you said just doesn't sound bad. It just sounds like people have to...
Painful. It sounds painful and long.
Yeah, but afterwards, it'll be sunshine and rainbows.
It's like having a nagging, infected, impacted tooth with no dentist in sight. Yeah, and you just hope that you don't get like septic shock and end up dying because of tooth decay, right? Like, let's hope that's not the plan. The plan is that the Federal Reserve is trying to slow growth. They're trying to slow employment data that's positive. They actually want employment data to be a little bit worse. Like, they want unemployment to go up. And they want people to not start getting as many raises as they're getting, and they don't want employers adding as many jobs as they're adding, and they don't want consumers spending at the rate that they're spending. So the reason for all of the rate hikes and the reason for higher for longer is trying to put a strain on the U.S. economy so that we can get inflation in check. The fear, like anything that you do, is an overcorrection, right? Like, I fear that when I'm parenting, my kid screws up. Is my punishment too much? Or, I put on a little bit of weight, and then is my new diet exercise regimen like too over the top? And now all of a sudden I'm doing things that are unhealthy, like starving myself or exercising to the extreme of like exhaustion. So, and that's the big debate, is like, has the Federal Reserve done enough? Do they need to take their foot off the gas? Do they need to let things sink in? Is it time for them to start decreasing rates? Because if they wait too long, then that's when we start talking about what we call a hard landing. And all of us in this country, we have this looming commercial debt crisis on our hands. And nobody really wants to talk about it. But there are upwards of half a dozen to a dozen banks that could potentially either go out of business over the next 2 to 3 years or need government intervention the way we saw it in 2008, because they could see their commercial paper go sour. And it would go sour because the landlords, the owners of these commercial buildings that have borrowed money against the buildings post-COVID, live in a world where people aren't going into the office. They don't need that 10,000 square feet. They don't need that 30,000 square feet. Heck, they don't need the 3,000 square feet in some cases, at which point they're not looking to renew. Or if they're looking to renew, they're looking to renew at a smaller space. And then all of a sudden, instead of only having 1 or 2 office complexes to look into, you have 68. Well, now supply and demand tells us there's an oversupply. There's not a lot of demand. Well, what you have to do is start decreasing what you charge people. The problem with that in commercial real estate, as you decrease what you're collecting in rent, the value of your property goes down. So now all of a sudden I need to redo my loan, because in commercial lending, it's not like a residential loan. Residential loans, we lock in that rate for 15, 20, 30 years. In commercial, 5 years, sometimes 3. Yeah. So you have 3 to 5 years, at which point you either have to pay it off or you have to refinance. Well, what if I took out my loan originally and my rate was 4% and my building was worth $10 million? But now, because I have too many vacancies, I have not enough people who are renting. The new people coming in aren't going to pay my $18 a square foot. They're going to pay my $15 a square foot. That means I'm collecting a lot less money in rent. All of a sudden, my property value goes down. Well, my bank is lending me based on the property value. Well, I could be upside down based on what they're willing to lend me. And by the way, they're not going to lend me at 4%. They're going to lend me at current market rate, which could be 7.5%. At which point that impacts my net rental, at which point it impacts my value. And we have a big cat and mouse game going on. So it is interesting. Something that we're watching over here at TLOP is, what is this going to do to the greater of the U.S. economy? Maybe this is what we need on the residential side to see the Federal Reserve get aggressive with their interest rate reduction, to then see mortgage rates follow suit because the 10-year Treasury followed suit, at which point people are willing to unlock themselves from their current situation and they're willing to put their homes in the market. Now, all of these millennial home buyers who are dying to buy their first house, they now can, because rates have come from 7.5 down to 5.5. And not only that, but there's more inventory hitting the market. So those are things that we're watching. Those are things that we're keeping an eye on. And, quite honestly, if that were to happen, that would make home prices continue to go up, by the way. Like, it would devalue commercial real estate values, and it would put a big financial strain on the banking system, but it wouldn't necessarily negatively impact the residential market, because the minute you put more inventory out there and you make borrowing cheaper, you're going to have a much greater demand for your product. And we still do not have a solution for creating more affordable homes. We're not building fast enough. So anytime someone's like, oh, the housing market's going to bust, I'm like, where's your data? What's your thought process? Walk me through it. Because if you have the data and you have the thought process, we can have a discussion. But if it's a hunch, I'm going to let you know you have a wrong hunch, because the data isn't suggesting it. Now, we go into nuclear war, World War III, we have another crazy epidemic, and then this time it works counter to what happened during COVID. Obviously, those are always the great unknowns, but then I always tell people we have things much bigger to worry about than our home being worth $350,000 and not $400,000, right? Like World War III, nuclear war, or some kind of a crazy epidemic that negatively impacts us economically. Like, okay, who cares about home prices at that standpoint? You want to talk about this, John, real quick?
Okay.
There's an article that I read, and I pulled it up on my phone. So if you're watching on YouTube, apologize. I have my phone out and you're just watching me scroll through. But there was a article that I thought was relevant to what we're talking about. And it's talking about the areas where we've seen the most inventory increase, right? Like, what states have seen inventory increase the most? So there's a state that has seen inventory decreased the most, and that's the great state of Nevada. So I have bad news for you in Nevada. Over the past year, this is March of 2023 to March of 2024. And by the way, John will get this up in the links as well. But, and this is information from Resi Club, RESICLUB. So, this is research and articles that I curate, I read. This is where I go for my information. And then we talk about it on the show. But then if it's really good, then we'll put links to it. I'll include it in the newsletter, et cetera, put it up on TLOP online. But Nevada is the one state that I see on this map that is seeing their inventory go down. Our great state of Florida.
Shout out Florida.
57% more inventory March of 2023 than March of 2022.
You don't see all those matchstick homes going up out in the swamp?
No, I don't see that, but it's going to be interesting to watch this. Now, by the way, I think the state of Florida still has only 3 months of housing inventory on the market. A healthy market is 6 months. So think about that. We're still half of where we need to be to have a healthy market. So I'm not concerned about the state of Florida having a oversupply issue. And last time I checked, people still want to move down here.
Why? Get away.
They still look at our weather. They look at us not having state income taxes, and they say, I want to live there. Now, the one thing they're not going to do is look at our affordability, because we used to be one of the most affordable states, and we had the good weather, and we had no state income tax. Well, now you look at what has gone on with homeowners insurance, and home prices have caught up with most of the rest of the country, at which point it's less affordable, but it's definitely better weather.
Price them out of the market.
But the state of Florida is one in which has seen the most inventory increase. No, I don't know if that's a damn it. That's something worth watching, because if you get too much inventory, that's when you'd see home prices slide. More
people, more traffic, more commute time.
Yes. I did that drive Orlando to Tampa. I used to be able to make that drive.
2 hours and 15 minutes, sometimes an hour and 45 minutes. Now
3 hours.
3 hours.
It's
like driving to Miami.
It's worse. Like when people have to make the drive, like, on the 5 in LA, or, doing San Diego to LA.
That's bad.
No, I think the drive on I-4 from Orlando to Tampa is as bad as being on the 5 in California.
It's not, because California has like 19 lanes and they're still full. Florida just has 4. So
Okay. So California wins that battle. Other states worth mentioning on this chart, the great state of Texas, their inventory is up 31%. That's probably the second largest, right behind Florida. And then states with declining inventory, we have the great state of Illinois. So Illinois has less inventory than it did a year ago. New York has less inventory than it did a year ago. A lot of the Northeast actually has less inventory, but more inventory is definitely Florida, Texas, and then California, because look, California is 20% of all home sales are California, by the way. California's GDP is the 7th largest in the world. Okay, so
shout out California.
So their inventory is up 11%. So things worth watching. Another big number, Minnesota, 30%. So we'll have this. It's a really cool interactive map, but we'll have the article posted up on the description here on the YouTube channel. And then finally, this is kind of me getting my panties in a wad. True story. I'm not even going to shy away from it, but I was reading this article. Oh crap! It just ran away from me too, John. So I was reading this article from, I want to call it something witch, Real Estate Witch.
Okay.
All right.
Sounds legit.
Yeah, look, Real Estate Witch produces content. What they're trying to do by producing content, like we all have a rub, we all have an angle, right? Here's John and I's rub and our angle. We produce a podcast in hopes that you'll subscribe to the newsletter if you're a mortgage sales professional. If you subscribe to the newsletter because you're a mortgage sales professional, maybe at that point you'll raise your hand and say, I want to be coached. I want more training. Then you'll join our MLO coaching community. And if you do so, you'll be grateful, because it's phenomenal content and we don't break the bank. We don't yell at you. We don't make you feel bad about yourself, but we do provide tremendous value, and we let you learn from top producers, and we let you be a part of a community where everyone cares about betterment and sharing of best practices. So this person's rub and their angle, my guess would be, they create content because ultimately what they want to do is generate leads for home buyers and then sell those leads to real estate agents. So we always have a rub or an angle. And this article is not that old. It was published back in March of 2024. And it's all about how much does it cost to own a home? And anyone who's tuned into me understands I preach that home ownership sucks the money right out of your bank account. Like I say that jokingly, but also wholeheartedly. There is a Freddie Mac statistic from back in the day that I think still rings true, which is your home will cost you 3% of the property value in annual maintenance. And really it's like 1 to 3%. 3% on a bad year, 1% on a normal year. So you buy a $400,000 house. Not only do you have your mortgage payment, but you also have to think about maintenance. Mm-hmm. So $4,000 to $12,000 annually in maintenance. But this article, because by the way, that still rings true. That Freddie Mac statistic still rings true. I want people to factor that into their budget when they're looking at buying a house. Now, home ownership also, that $400,000 house probably went up in value by 15 to 20 grand on average, based on 70 years worth of data. And because you are owning your home, you are paying down a mortgage by $5,000 to $7,000 in your first year, $6,000 to $8,000 your second year, $7,000 to $9,000 your third year. You see where I'm going with this? So it was like a forced saving. So you're paying down a loan, which is equity, which is your money, which is wealth down the road, while your home's also appreciating. But you do need to factor in as a home buyer, hey, now that I'm a homeowner, I'm gonna have to fix shit when it breaks. But this article is trying to compare how expensive home ownership is, and we'll post the article so people can see it. But I just have a big issue with it because first and foremost, they talk about homeowners insurance. That's a cost you now have. Mm-hmm. And I get that. But for most of my clients, John, over the past 15, 20 years, when we compare renting to owning, their mortgage payment 90 times out of 100 includes their homeowners insurance and their real estate taxes. So if their mortgage payment is in line with what they are paying in rent, then when you rent, you also pay taxes and insurance. You just don't pay it separately. It's rolled into your rent, but your landlord has to pay it. So when your landlord's figuring out how much to charge you for rent, they are factoring in how much is their cost to insure that property and pay the taxes. Yeah. So I don't think it's fair to include the cost of property taxes or homeowners insurance into the true cost of home ownership when I'm doing a comparison to renting, because I should be comparing my total monthly mortgage payment, that's principal and interest, that's PMI in certain cases, taxes and insurance. That's a total mortgage payment for 90% of homeowners who have a mortgage. There are 10% who they pay their taxes and their insurance separately, but most of us pay our taxes and our insurance included. So I'd want to compare rent for a home of that size versus a mortgage payment for a home of that size, understanding that part of my mortgage payment is taxes and insurance. So I had an issue with that. And then I had an even bigger issue with utilities. Okay. Utilities.
Yeah, everybody has to pay them to live. That's like saying I have to own a car, but then I have to put gas in it.
Yes. Like I just, and they use this graph and this chart of, average annual cost on top of mortgage utilities, $5,362. I'm like, bro, I don't know. It's been a while, but I rented 2 apartments when I lived in Atlanta, Georgia. Both apartments, I had to pay water. I had to pay electric, right? Like I had gas bills. Like I had utilities. I rented an apartment in West Palm Beach, Florida when I lived there. Guess what? I had utilities. Yeah. So are you saying that only homeowners have utilities? Like that to me was a little bit misleading, or the word I would use would be asinine, to be including utilities. It's one thing to put in maintenance. Hey, look, if you want to say that on average, I'm going to spend $4,392 on maintenance. All right, cool. Like you mean I got to do my lawn? You mean I need to pressure wash my driveway? I need to reseal my pavers, like repaint the house every 10 years. Like, sure. Okay. Fix the AC when it breaks. Fix the dryer when it goes out. The hot water heater needs a new element. Like, sure. I'm down for maintenance. I'm down for improvements. Utilities I have a big issue with. And I want to sit and argue property taxes and homeowners insurance. So just a little food for thought that there's some information out there that I think is misinformation. I don't think that we should be factoring all of these things. I think we should be sticking to the Freddie Mac statistic that I've been using and quoting and teaching from for the past decade, which is y'all just need to understand when you do become a homeowner, that home is going to cost you 1 to 3% of your property's value in maintenance and repairs.
Holy shit.
That was a lot, right?
I don't know, man. I'm trying to keep my eyes open.
All right. Well, hey, I'm going to do this, John. I'm going to find a way for us to wrap this up,
Yes.
conclude, let
it
everybody,
up.
I want to let everyone know this about us being at the gathering. And I don't know, are you going to drop this while we're at the gathering? Do you know, or are you going to drop this before we go to the gathering?
Oh, I don't know.
All right. I don't know either. But there's a good chance if this drops before we head out to the gathering, y'all should make sure you're following us because we're going to be reporting live from the gathering Sunday, Monday, Tuesday, Wednesday, reels, stories. We're even going to try to go live so that we can bring you what you're missing so that you stay in the know as we go from session to session or as we network with some of the who's who of mortgage and real estate. On that note, you missed out on the gathering more than likely. Don't miss out on coming out to Mastermind Summit 2024. If you're a mortgage sales professional, MLOs, mortgage brokers, this event at Resorts World, first week of June, all the information is on the website. Y'all, it's a party. It's a great networking opportunity, and you can get your learn on and rub elbows with some of the best in the industry. Come hang out with me, JC, and the rest of the TLOP crew. I'll be speaking on the main stage. They have another dozen or so great speakers that are presenting on from the main stage. And that's first week of June. You can check out all the information on TLOP online. The event's called Mastermind Summit 2024. He's John Coleman. I'm Dustin Owen. You have just tuned in to the latest episode of the Loan Officer Podcast. That's all the time we have for you today. We do look forward to catching you on the next episode.